This is Robert Kraft, and I'm your host for the Investors Roundtable. This is episode 6, and this is an early morning recording because we have a truly global audience. We got individuals from all over the place, and actually a few people here that I haven't. This is my first time meeting, so this is going to be a lot of fun. And I'd like to introduce everyone who's joining us for this panel. We got Matthew Peterson from Peterson Capital Management. We actually did an interview on the podcast a few episodes ago, so I invite everybody to go check that one out. We got Jeremy Deal from JDP Capital Management. By the way, I should have said everybody give like that. That's me. Yeah, sorry.
That's me. Yeah. I'm present.
And then we got Shaun Noll from Fortress Investment Group. Shaun, thank you for joining us. Just do like the, yeah, okay. And then we also got Jeff Henriksen from Thorpe, Abbotts Capital. Jeff, thank you. Thank you, Jeremy. Thank you, Matthew. And let's get after it this morning, dudes. It's early here on the West Coast, a little 6:30 action. So I appreciate everyone getting me up and at 'em.
Yeah, it's kind of unfair for me because I've had about 6 cups of coffee today, and it's 3:30 p.m. or something. So I feel like the one that's the most advantaged.
Well,
so maybe
that means you're talking.
Invert it.
That means you're talking the most. All right.
Okay.
That's what's happening. All right. So real quick, before we get into some topics and everything like that, Jeff, Jeremy, Shaun, since this is the first time I'm even, Jeremy, we spoke before, but it's the first time hearing and meeting you and doing an interview or anything like that, very quick, let's get like kind of a one-liner or a couple lines on your investing philosophy and your background. Let's go counterclockwise. So I'll go, let's start with Jeff, and then we'll go to Jeremy and then to Shaun.
Yeah. Okay. So, Jeff Henriksen, based out of Charlottesville, Virginia, run a firm, Thorpe, Abbotts Capital. We are a very value-oriented investment operation that's focused on behavioral economics, behavioral finance, and our focus is really on understanding and finding mispricing and market inefficiencies, and trying to really understand the psychology and the behavioral elements to create mispricing and then take advantage of it. And my background, I've been doing this. Well, Thorpe Abbotts, we launched this fund in November, but I've been investing full-time professionally really since 2008. And that's my background. I'm also a fellow at the University of Oxford, and I teach there a couple times a year, valuation and financial modeling.
Awesome. Hey, that's a good time to start 2008, right? You're a born contrarian. Let's go.
Right. Absolutely.
And Jeremy, let's go to you.
Yeah. So I launched JDP Capital in 2011. Part of that I was in private equity, and part of that I worked for Honeywell. And I moved to Amsterdam about 3 years ago. Very little to do with business, more of a lifestyle choice. And my girlfriend and I are expecting our first child in December, so we're super excited about that. So JDP is a concentrated value firm. We generally have between 5 and 8 high conviction positions that companies we think can survive and thrive for very long periods of time to try to outperform the market, with individual companies that can grow faster than our benchmark, which is the S&P 500. So companies that can have the opportunity to reinvest 100% of their gross margin back into the business at very, very high rates of return that we don't have to trade, and we can have a 5 or 10-year view on. We also have a special situations overlay, which used to be a lot bigger part of the strategy, and now it's a maximum of 10% allocation, and those are distressed super price dislocators, maybe we call it maybe deep value, where there's a mean reversion kind of idea, and limited to 10% of the portfolio because it's because you have to trade them, and they're just harder things to own. But the core of the portfolio is a handful of companies that we don't have to sell for a long period of time. They're growing faster than the broader market in a sustainable way.
Nice. I mean, since moving to Amsterdam, by the way, congratulations. Expecting your first kid. That's so awesome.
Daughter.
Yeah, there we go. Yeah. Join the Girl Dad Club. Let's go.
That's right.
There you go.
The world needs more female board members. So here we go. We're making some.
There it is.
Yeah.
That's for damn sure. But real quick, I mean, since moving to Amsterdam, I mean, I know we talked offline how, you still invest in U.S. equities,
mostly U.S. Yeah.
Exactly. So, I mean, have you started looking abroad as well at global assets too, to bring into the portfolios, just because now you have this more exposure to Europe?
Yeah, absolutely. So personally, I've invested in a machine learning fintech based here, and that's been a really interesting experience, but not necessarily for the fund. But that's opened up and relationships with other investors in the sector, and just broader speaking, and have become more interested in mostly kind of Dutch businesses. There's a lot of great growth companies here. There's a lot of great old economy businesses as well. So I've also woken up to how different each country, the business in each country is. So when you're in Austria, for example, the majority of the companies are the highest quality companies like Red Bull, which is, probably one of maybe the largest company in Austria. Most of them are private. Same in Germany. But in companies like Holland, you have a lot more publicly traded large businesses. So each country really different as far as the public versus private. But I have not, outside of Spotify, which is one of our largest holdings, not necessarily investor for the fund in Europe, but I would be open to it, actively looking all the time. And it's definitely opened my horizons to what's out there. It's a big world.
Yeah, making that bet on podcast networks. Let's go. All right, I like that. So, I would like to now throw it to Shaun. Quick blurb, your background, investing strategy.
Yeah, my name's Shaun. I manage family office for one of the founders of Fortress Investment Group. So I don't work directly for Fortress. Before that, I managed a hedge fund that I started for a number of years, and then before that, I managed a different English family office. Here we have broad investment mandate, and I think my primary focus is just on owning great businesses and trying to own them for long periods of time. One, because I don't want to pay any taxes, and two, because I think that's the best way to generate a lot of returns. And so really searching for the best businesses in the world, and I want to own them in size, and I want to, hopefully, if they continue to perform, own them for long periods of time. But ultimately, we have a broad investment mandate here, and I think probably our two biggest competitive strengths are that we can take a long duration, since we're non-institutional investing, and we also have very high level of flexibility given the nature of the capital base. So I think when we can leverage those two strengths, those are a big competitive edge. But yeah, happy to be here. Thanks for the invitation.
No, absolutely, Shaun. Very cool. And Matthew, for shits and giggles, I know we can direct everybody
for anybody who didn't watch the last podcast. That's right. So Matthew Peterson, I run Peterson Capital Management, which similar to these other funds, it's a long-term value-based fund. We launched, actually, Jeremy and I launched our funds on the same day in 2011. Prior to, the fund is long-term concentrated value. We sort of look at things in two avenues. There's sort of the Graham, the Ben Graham, not necessarily nets, but the deep value opportunities that aren't necessarily compounding, but can mean revert. And then there are the more Phil Fisher style investments, which I actually prefer because those are the long-term compounders that we can hold literally for a decade or longer. And, I've been investing professionally for over 2 decades. So this is kind of the third major financial crisis that I've been investing through. And I think it's amazing. There's a lot of similarities and there's a few differences. And it's actually an incredible time to be putting money to work.
Sorry, we just had another earthquake here. That was crazy. We were woken up to one this morning.
Oh,
wow,
that's
Jeez.
Holy crap. Wow.
Wow.
That's okay. A first. That's a first on the podcast.
Yeah,
there we go.
That's not a 6. That's a first.
Yeah, out of 6. Yeah. Well, we're on. Okay, we're all good.
Is everything all right?
Everything's. Nothing's full. We got a shelf right here.
I don't see cracks in the wall behind you, so that's a good sign.
Yeah.
This isn't the big one yet, hopefully. Okay. But anyways, wow. So if anybody watching, look, LA is a great place to live. We get earthquakes. We get, I think that tsunamis every once in a while. But
I heard California has a really low tax rate too.
Oh, the lowest. The lowest, right? I think.
By the way, I should mention we just joined this migration out to Austin, Texas. So I was recently in LA where Robert is, and we just came out to Austin. It's been wonderful here. We got a lot more space. It's been very nice. And so Jeremy, you're over in Amsterdam. Shaun, San Francisco, right? And then Virginia here for Jeff.
Yeah.
So kind of all over the
Charlottesville.
place.
Yeah. I mean, we were all talking offline. We were just like, because Jeremy kind of was one of the first to make that, I'm going to Europe. I want to check this out. I want to look at the land. I know this isn't necessarily an investing conversation, but it actually could be from an economic, because at the end of the day, like, I think quarantine has caused us all to really think about like, okay, where do I want to spend, actually I was thinking about this yesterday. It's not so much like, okay, if I had to be in quarantine again, where would I want to spend my time? It's like, okay, when I'm not in quarantine, what are the things I like to do? And really thinking hard about that. Like, what are like the minimum things I'm like, damn, I really miss these things. Where else could I do that? If I don't necessarily like the area that I'm living in right now, what do you guys, what do you guys think about that?
I think it's awesome. My business partner, Robert, was saying the other day, he lives in Chapel Hill. He was saying, he was thinking about it. He was like, there's no need. He's like, I mean, now that schools are all canceled, we're homeschooling. He's like, I wish we lived on a lake. He's like, I'm living in Chapel Hill in town. He's like, I lived on a lake, have a boat. And I mean, he was kind of, I think, kidding around, but halfway, probably not. Like, I think it's gotten to the point where a lot of people are thinking about where can I live to maximize happiness, if you will, and then still obviously be able to deliver on the job front.
Yeah,
I'd expect we see some downward pressure on real estate prices in major cities because I think people are just sort of they're happy to have a little more space now, and if you can work remote, which is the key aspect, you don't necessarily need to be next to your office. You can get a longer commute time, but you don't actually have to do the commute. So I would expect to see a little bit of some downward pressure on real estate prices inside the cities, and then maybe prices go up a little bit outside the cities.
And I think what we're seeing too is so many people move to the cities for the wrong reason, or they live in a place because the company's based there. It's not because that was their natural kind of like, I want to live there anyway. And it's now kind of unleashing that. I've got 4 or 5 friends that have moved or in the process of moving, whether it's from Seattle or from San Francisco or from Manhattan, that are moving to kind of random places. Well, not random, but places that are important to them, places that they look up and say, this is where I want to spend my time. And I even have a friend whose girlfriend is with Microsoft, and they decided to go to the U.S. Virgin Islands because they told Microsoft apparently said you could work from anywhere, any U.S. territory for the next, I don't know, year or something. So they're going to the U.S. Virgin Islands. Like, that's not where I would go, but that's where they wanted to go. And that's what this is unleashing. So it's really an exciting time if you can work from home, if you have that flexibility, because there's no reason to have to, I don't know, if you don't have to live in a city, you shouldn't.
I mean, look at the programs in like Bermuda and Barbados going on right now. I mean, like, hey, we'll take it.
Yeah, and by the way, Jeremy, to that point,
angle though, where like sometimes the things that seem the most stable, like high quality real estate in big city names, are actually very vulnerable. And you're seeing disruption across asset classes and across businesses that I think were previously unimaginable. I know there was a lot of real estate in San Francisco Bay Area traded at 1%, 2%, 3% cap rates.
Yep.
Now it's going to get devastated from an investment perspective. I saw somewhere the other day that rents in San Francisco were down 12% last month, in a month. Right? If you lever that 10 times and you can't sell your property. I was reading this interesting stat a while back that was done in London at one point where they thought that a 1% change in demand for real estate had a 10% impact on the prices.
Yep.
Yeah.
I think there's a lot of things that are happening right now that are really unprecedented.
But do you think that's sustainable? Like, if we come out on the other side of this in 2 years, are people going to want to be in other places, or do you think there was an interesting article in the Wall Street Journal the other day talking about this. I think it was in the Journal. But basically the gist of it was the argument was that after everything kind of normalizes, that you're going to see demand come back to New York, San Francisco, to all the major, London, major population hubs. So do you guys see that happening, or maybe not to that kind of mean reversion, if you will, maybe won't happen this time?
I mean, we'll have population growth. We'll have eventually wage growth again. So it's not like real estate will be down forever, but certainly I think that this is, if there's any lasting impact, it's that people might actually relocate, and that relocation will have at the margin an impact on real estate prices, inside metropolitan areas and rural areas.
Yeah,
and the exodus was happening before, even to a degree. Sorry, Jeremy.
Yeah, so maybe like if you're 25 years old and you're getting your first job and it's, you want to be, it's a Google or something, part of the experience is being around other people your age and climbing the ladder and going to the employee cafeteria and all that. But for people that hit a certain age or they want to have a family or whatever, like that grind just isn't as important. So I kind of see like there is a value in having an incredible campus, being able to hop around between major cities if you work for a big company. There is a drive and a growth that comes from being around and close proximity of other people, but it's not for everybody, and it's not for all parts of all stages of life. And then again, maybe when you're an empty nester and you're in your 60s and 70s, maybe you want that interaction again to feel younger. Maybe you want to move back to the city, but what's changing is you don't have to. Maybe you have more flexibility than you had before, and that's what's exciting about it. It's just if I want, nothing against San Francisco, but if I want to move there, it's because I really want to move there. It's not because I have to for to get FaceTime with my VP because I want to work in tech or whatever, or New York because I want to work for Goldman, so I have to live in Manhattan. And maybe that's one of the biggest shifts is I want to live there, so I will. But if I don't, I don't.
Right. I mean, I think like we all are talking from a place of, we have that privilege where, all of us can work from home, we can go and do what we do anywhere in the world, so we have that. So, so really we're speaking to that audience that has that flexibility and has that privilege where they can go and do what we're doing anywhere that they want, but there's always going to be a need to have, not just essential workers, but there's, law firms, accounting firms, these types of doctors, healthcare workers, they need to be a lot of healthcare workers, we all know, because we all have doctors as friends, I'm sure that, hey, they don't even get to choose where they get to go to residency. And then they're end up there for 5-10 years, So, I have a good friend who never thought he'd move to Orlando, and now he's been in Orlando for 5 years. And, it is what it is, but he's built a great life for himself. But at the end of the day, my main point being is that, I think at the same time, while we might be in that area of privilege now, I think it's slowly starting to change in many different businesses, where they have that flexibility so that you can go and move wherever you want. Like my main point of saying before Jeremy said something was that the mass exodus has been happening even before quarantine. I think just quarantine has sped up that thought process of like, either I can do what I do in another place or screw it. I'll just I try and keep this PG-13, right? I'll go where I want to go and I'll just get a job there. Screw it. I'll figure it out.
Right. Well, I think a lot of that has to do with the tech development that was taking place. So prior to COVID, obviously we could now do video calls, but it wasn't widely accepted. So you still thought you had to go out and shake the hand and do the face-to-face contact. Now it's just been, now it's just openly available. I mean, people expect my children to run into the middle of the podcast, and it's a non-issue. So.
Yep.
But I mean, is that sustainable though? Because like I had a friend of mine that was saying, I did a meeting with a client, first time meeting, and the potential client rather, and the person was in Hong Kong, and my friend was in London, and he was like, normally I would get on a plane and fly to Hong Kong because that's how you win business. But with this pandemic, now everybody's used to just doing a Zoom meeting. And he's like, so I think it's going to permanently change, for instance, business travel. And I think, well, there's maybe some truth to that, but then I'm kind of thinking, all right, well, from a game theoretical perspective, let's game this out. So let's say we get to the other side of the pandemic and I'm a competitor with my friend and we're competing after the same client in Hong Kong. And by the way, you can travel again because the virus is under control. And I know that what he's going to do is Zoom it because that's kind of what he does. So what's my best response to his move? Well, it's actually to get on a plane and fly to Hong Kong because it's like, hey man, he Zoomed with you. I'm here face to face. And then now if my friend knows that I'm going to do that, his best response to my best response is to fly as well. So we're back to a point where we're all flying again. So I think there's some chance that could happen, but I don't know.
You can't replace human connection. Human connection.
Right.
It just is what it is. I mean, you're never going to replace that. And every year we meet up in Switzerland, and you can't replace that. And the conversations that we have, Prague, and we're in clusters, and the late nights talking about business, and talking stocks and talking about life and, you know, in person. We just could never do that. We couldn't have it. Zoom, we'd never be able to have that same impact. And the relationships that we have are because of those relationships that we were able to, those bonds that we created in person. So I totally agree that there's got to be a balance, but maybe it's less, right? Maybe you see each other once or twice, and then for the rest of the year, you don't have to travel as much, or there's some happy medium. But I do feel a little stronger about the live where you want to live. Maybe not for everybody, but you shouldn't have to live. I mean, there should be a little bit more flexibility. I mean, I look at my partner, Lily. You know, she works for a big Dutch company, and she rides her bike 40 minutes each way to work, rain, ice, wind, you know, 7 a.m. And she says that, you know,
Awesome.
most of the day is spent just like at the water cooler, having conversations, like meetings about meetings. And now she's been at home since March, and they're able to get just as much or not more done. And she can't even fathom getting on that bike at 7 o'clock in the morning in the dark and cold. And, you know, it just seems kind of irrelevant whether she lives here or lives, you know, in Portugal.
She misses the bike ride a little bit. Come on. That actually, on the nice days, that sounds nice.
Yeah, 10 days a year that it's nice.
Jeremy, that's interesting. Out of curiosity, you've been traveling a little bit around. What do you see? What do you see in terms of the COVID response?
I just got back from Mallorca. Incredible. Restaurants are full. Beaches are full. People are out. It took me an hour to pick up my rental car. People are obviously considerate, you know, 1.5 meter distance, which is about 6 feet, have the mask, but went out for a big birthday dinner last night with some friends. You know, yeah, just life's back to normal. Like, people are not living in fear. I drove all over Austria last month with Lily's family, from north to south. Yeah, I mean, people are being cautious, but
I think
life is back.
Right. I think this argument that that post-pandemic, people are going to be less willing to go in public and all that, I think it's total garbage, because you're already seeing, I mean, we're still in the midst of a pandemic, and you are seeing the demand for people wanting to get out, wanting to get back to normal. So I really do think once, you know, we can debate on when that will be, but a vaccine and herd immunity, some combination of that and treatments, once we get this thing under control, I think people they're going to want to go back to.
Well, as an example,
normal.
It's totally that's right, because as an example here, the European Union borders are closed outside Europe, but within Europe you can travel. So the streets here are packed with Germans and Belgians and Italians, and even a month ago you didn't see it, but now when I walk home, I hear 10 languages. I see, you know, boyfriend, girlfriend on the weekend vacation to Amsterdam, walk in holding hand in hand, or the weekend vacation in front of the Heineken building. I mean, it's the only thing that's missing is like the American travelers and the Asian travelers and all that. But people, as soon as they could start traveling again, they started. And you know, I think we're just going to live with it. I mean, nobody's going to hunker down.
You know,
forever.
Jeremy, so I'm in Texas now, and we're obviously having some spikes, but there's some, it's really obvious here. You see that people are truly social animals, because the moment that we opened up, it was like, and we're seeing it across the nation, but people want to be at the beaches. People want to be at the restaurants. People want to go out and see their friends.
Absolutely.
And, and they really, you know, I'm an advocate for masks, but they don't want to be wearing masks. So I think as soon as we get some vaccination, and that could even be a little later on this year, you're going to see people heading back out and really putting their money back into the economy.
Well, I think there's an interesting case study. Like, a lot of people brought up the Spanish flu comparison early on, and I think for some reason a lot of people didn't sort of follow that up with, we had the Roaring 20s after that, where people got so nuts we had to ban alcohol because they were just partying too crazy. And like, you know, I think there's a real risk that, I mean, you know, I think that the micro of businesses basically always trumps the macro over some period of time. So I don't like to pontificate too much about long-term stuff, because in the end, nobody knows. Most people are wrong. But I think there's like a real risk that the market crashes upwards, actually, from some combination of people snapping back and the economy coming back much faster than people expected. I mean, we will for sure get a vaccine, for sure get effective treatment. maybe that takes 6 months, maybe it takes 12 months, but in the context of, doubling some large piece of capital, like 12 months is not that long in real life, right? Like the life of
Yeah.
you have to wait 12 months, that's totally fine, or even 18, whatever it is. But, the market charged higher for years after the Spanish flu, like in an unprecedented bull market. And today we have the same setup, but there's no other asset class on earth that's interesting outside of public equities, really, aside from
That's right, Shaun.
Nuts. Real estate valuations are nuts. Private equity valuations are nuts. We have the best businesses with the best management teams in the world trading in the public markets at valuations that are like half of their private market comparisons, that are better businesses growing faster. I think there's like a real chance we're either heading into a renaissance for public equities, or we get some inflationary pressures and it just crashes upwards also. Like all of us were talking about this the other day. What do you think are the odds that the S&P can trade at 25 times or 26 times earnings?
I mean, in a world,
that probability, what would you say that probability?
I mean,
well, in a zero interest rate environment.
Right. Zero interest rate environment. You have better quality businesses now that have more asset-light business models that can reinvest incremental capital at really good rates of return.
With growth.
Growing while investing, investing incremental capital, earning above their cost of capital, growing all the value creation that you can get out of growth. You've got, as you said, great management teams. Management quality has arguably gone up over the last 20 years. And you have, what's the 10-year at right now? What's the 60 pips or something? So it's
negative in Europe.
Yeah. I think they could easily trade at those kind of multiples. And Jeremy, you've talked a lot about this. And the dumbest analysis that you see people do is they'll say, oh, well, the S&P is historically traded at this multiple, and therefore we're above it, and therefore stocks are expensive. Yeah. And Jeremy did a presentation at ValueX last year where he really looked inside the S&P and looked at how the constitution of the S&P has changed. And these are different. Technology, and Jeremy, you know the numbers better than I do, but technology is a much larger percent of the S&P 500, say. And those are much higher quality businesses that should trade at higher multiples than the old industrial concerns of back in the day. You couple that with a much lower interest rate environment. To me, that is not a crazy scenario at all.
Right. What makes me excited is regardless of what you want to bet on in the market, there's something amazing to own. Even if you're a guy that can't pay more than 5 times earning for something, there's stuff for you to buy. There's a ton of companies that are down 30, 40, 50%, some 90%. From their highs a year ago. So if that's your bag, you can do that, and that's great. If you're a tech guy, there's tons of amazing stuff. Not everything is overvalued. Not everything is up 200%. There's incredible opportunities no matter where you look. There's something like 6,500 stocks just in the U.S. and we're at just this really interesting time where it's 31 flavors. It's whatever you want, you can find. And I don't know how you could hunt for investing outside of the market at this point.
Yeah, nobody has a crystal ball, right? So the macro is hard to predict, but if you sit back and just look at the opportunity cost of capital, Shaun, we were talking about this just a few weeks ago that there's $5 trillion sitting in money market accounts at banks right now, and that is just so different than previous crisis. So think back to 2009, there was this again unprecedented stimulus package, which was $700 billion that went to bank reserves. That's very different than what happened this time, which is $8 trillion, mostly in cash in terms of like PPP loans, unemployment, stimulus checks. And there's now $5 trillion sitting in money markets earning zero. So if we have Powell keeping rates low and we have sort of this fear of missing out and maybe a little bit of inflation, which I've been expecting for a few years now. So perhaps we do get a little inflation. There's going to be this huge pressure to get those assets invested. Earning zero is not attractive if markets keep climbing. So again, Shaun, I think there's definitely a decent chance that we trade at higher multiples.
I think a lot of times, like I said, I think business trumps the macro. But still, if you think about the incremental capital flows, what is going to drive price direction? Like, what is the scenario that nobody is positioned for? Because that's the incremental direction capital will flow because nobody is there already.
Right.
And if you think about, and like when I think about it, everybody I know and I talk to outside of some of the gentlemen on this call are so bearish and so negative because there's so much uncertainty is how I hear it quoted over and over again. But if you think forward and think that there's a realistic chance the S&P could trade at 27 or 28 times earnings, especially if it's growing rapidly, because in an inflationary environment, companies with no assets, and reinvestment opportunity, their growth is going to accelerate. You could see the S&P double, I think, over a 2 or 3 year period, which would just shock people. No one is positioned for that.
That's for sure. Well,
that could totally happen. Pick your percentage probabilities. The S&P trades at 27, 28 times earnings on 210, 220 of EPS and 2022 or something on a forward number. And I don't think that's as unlikely a scenario at all as the world seems to be portraying it as. And you're already seeing some moves in other asset classes indicating that could happen. You're seeing gold rise to new highs. Why is it doing that? I love it when people say things like, this just doesn't make sense, because I think it indicates sometimes the market is stupid and it's doing something stupid, but a lot of times it means that there is something structurally secular happening that people don't understand, and that it started and they will begin to understand it over time, but they haven't understood it so far. And so it means that it has room to run. There's so many examples of this. I know it's a controversial topic among value investors, but I think Bitcoin could be an example of that, where people are like, it just doesn't make any sense. And you're like, well, we can talk about what that means, but I think there's actually a there possibly, and it might go to zero. And I don't know. There's a lot of outcomes for that, but there's something happening there, and people are saying it doesn't make sense, and it just keeps going. And I can see the equity market. A lot of people this year saying it doesn't make sense, and I think in my mind it makes perfect sense. And it indicates to me that there's probably a lot of legs to this that people are not prepared for. And the $5 trillion sitting on the sidelines indicates they are not prepared for this.
Right. Well, just to echo that, when I hear people that are so bearish, when they start talking about an individual stock and they just say, they throw out some crazy number, like it trades for 1,000 times earnings. And I go, tell me one thing about that company. Tell me one thing about that company other than just the simple GAAP accounting screen that you read in a Wall Street Journal article or heard the narrative on somebody's talk show or whatever. Tell me what the revenue is, tell me what the cash flow is, tell me what the gross profit is. And I'm okay with somebody, with that debate around valuation or whatever, but generally what I hear from the bears is just macro stuff, so completely unrelated to the underlying business. They have no view. They don't understand the business. They have no kind of opinion on where something's going, because if it doesn't screen cheap, then they just can't be bothered with asking themselves, what is this thing worth? So, long term. And I totally agree that you have to ask yourself, first of all, it's okay that nobody agrees with you, because that's the business we're in. That's supposedly what we're being paid to do, is be contrarian investors. And right now, one of the most contrarian things is to actually dig down into a business and have a long-term, high-conviction idea that it's going to continue growing. And,
Jeremy, do you think that investor mindset, bear or not, this idea of uncertainty and, maybe not being as optimistic as Shaun, is weighing down even your individual company analysis? So you're looking at that company that otherwise you're like, wow, this hits all my valuation metrics, this and that. And whereas Shaun has been able to train his mind to say, hey, let's think about the upside when everyone is saying everything's going to hell, but now we're talking about that person who thinks everything's going to hell, but then they're looking at that individual company valuation and just having a tough time to getting over that block of but it's still just so uncertain. I mean, what do you guys think about that?
Well, Buffett talked about this. He said there's never been a time in his 70 whatever years investing that hasn't been maximum uncertainty. So he says you're always going to have extreme uncertainty. I mean, just in the few years we've run, the fund is now 9 years old. Just in the period I've been running the fund, we've dealt with, double dip. So when Matt and I launched our separate funds on the same day, the big fear at the time was a double dip. Everybody was convinced we were going back into the recession and stocks were just going nuts in 2011. When we launched, happened to be great because somehow the clouds lifted and people thought, oh, I guess we're not going into double dip. Then it was the European financial crisis and Greece, and everybody was being prepared for for the euro to come apart. Everybody was going to go back to Europe.
Brexit.
Not only it was you were going to go back to the drachma and the peseta and the German mark, and banks were kind of preparing for this blow up of Europe and what that meant for Europe or for the rest of the world. And so stocks were just, and then it was Obama getting elected, and the markets fell apart because a Democrat got elected. I mean, and then there was the debt ceiling. I don't know if you remember this. Like, remember there was these financial professionals. CNN did something on these financial professionals that were spending Christmas and New Year's instead of with their family. They were paying close attention to the update on the debt ceiling. I'm like, are you kidding me? Like, that's are you really that much of a slave to your job? Like, you give a shit about the debt ceiling debate? And that's kind of stuff yes, I guess there could be a nuclear disaster. We could all just die and everything goes to zero. Fine. But those aren't the things I'm thinking about, because if we all die, then we all die. So, we've lived with so much uncertainty just in the last 9 years. And it's only going to continue. So as a fund manager, your job in a way is to continuously deal with uncertainty, because your investors are uncertain and the market's always going to be uncertain. And a part of that, what plays into that is the fact that it's liquid. If you have illiquid assets, it's funny because if you go talk to private equity fund managers or real estate investors, they're not nearly as uncertain. They're not nearly as skittish, because guess what? Their assets are private. They don't have that liquidity concern. They don't have the concern of people redeeming. They don't have mark to market monthly, the need to mark to market every month. And so they're all of a sudden they can take a longer term approach, the approach that we're supposed to be taking, which we do. But the uncertainty is more of a function. I see the uncertainty is more of a function of the liquidity of where stock prices are going in a day or a month than it is actual uncertainty. I don't think people believe we're all going to die and go to zero, but people are really more concerned about the short-term pain of watching their account go up and down.
And that's why people like real estate, right? Because it's stable. That's what you hear all the time. Oh, real estate is stable. I'd rather own a building at a 4% cap rate in town than own an equity that I can buy at 5 times earnings. And the reason is because it doesn't go down in value. And when I tell people, I'm like, yes, it does. You just don't see it. I mean, like, if you had to go sell that asset today and the market is completely imploding and the S&P is limit down, guess what? You're not seeing it, but that asset's worth less today than it was yesterday. But the thing that I've seen is that people, and this is a human, just, it's part of our evolutionary heritage, but recency bias is a very powerful thing. And it's why prices of flood insurance always goes up after a 100-year flood. Well, the probability of having a 100-year flood, just because one happened yesterday, is still 1%, right? It's 1 in 100. But yet people extrapolate what just happened, and they overestimate the probability that's going to happen again, and it causes flood insurance or any kind of insurance after a big disaster happens. The price of it goes up. Well, with the market, what we're seeing now, I think people, they can't get past the daily virus updates, the death numbers, which are terrible, but they see all of this and they're just extrapolating it forward, and they can't look through to the other side. And that's why you can find publicly traded equities. I mean, I know the market's rallied a bunch since the bottom, but there are still companies trading at fractions of what their intrinsic value is. Good businesses. I'm not talking dying businesses that are value traps. I'm talking solid businesses, and people just don't want to touch them. It's too much uncertainty. And they turn on CNN or whatever the news they're watching, and it's more negative news on the virus, and it's GDP numbers coming out this morning. It's a terrible number, but it was expected, and it just all gets extrapolated forward. And until that narrative changes, you're going to see a lot of volatility, but it will change. And when it does, it will be the recovery narrative. The narrative will come out. It'll be $5 trillion of cash coming back to work, people traveling again, virus numbers down. I mean, we are going to get to that place. I don't know when it's going to be, but we're going to get there. And you want to own companies that are going to, the equity claims are still going to be intact, and they're very, very cheap, and they've got the liquidity and the financial wherewithal to make it across this economic desert that we're in. But when you own them and we get to the other side, they're going to be worth multiples of what you're paying. I mean, we're investing in companies now that, almost our entire portfolio, we believe once we get a mean reversion, will at least be a double. So I think investors really need to look through what they're seeing today.
Yeah, I agree. I think that
actually, and you other guys too, I'd be curious to get your thoughts on this. like, there are companies out there today that private equity managers would die to own at today's prices.
Right.
A lot of these management teams just wouldn't work for private. Like, you think Jeff Bezos would ever work for a PE shop? Not going to happen. So, like,
Daniel Ek, they're not for hire.
Right.
Can't get them. Yeah. They're too good.
Yeah, they're
not going to go work for Blackstone. Yeah.
Yeah, they're not going to go work for, you know, some middle market PE shop or something. Like, they just don't have to do that. So how do you guys, like, educate your LP? I mean, the famous stat that everybody that always blows my mind is that, you know, Peter Lynch had a 20 or 20% CAGR, and the average return for his LPs was 0 because they top ticked the top and they bottom ticked the bottom, and their behavior was so bad that they outweighed one of the best investment track records in history. So how do you guys, and Matt specifically, like, how do you set your capital base up, or like, what do you do to work with your LPs to try and counteract that natural, I mean, this is a human instinct, the natural thing everybody does, you know, has this going on in their head all the time. And one of the things we get paid to do is to not, you know, is to be good analysts, but also be strong on the behavioral side. Like, how do you guys work with your LPs to try and make sure that they maximize their own return and that their own behavioral biases don't shoot themselves in the foot?
Such a good question, Shaun. I mean, I agree. It's part of our fiduciary responsibility, I think, to help educate our LPs. And the natural everyone knows you want to buy low, sell high, but surprisingly, and you know, people sort of treat public markets, the liquidity of public markets, as an advantage. Yet we see time and time again that people actually create a disadvantage for themselves because the liquidity is available. And you know, there's a trend, or there's a tendency for people to treat equities like Giffen goods, where the more expensive they become, the more they want to buy. And then the cheaper they become, the more they want to sell. And it's absolutely backwards. So, you know, I spent a lot of time trying to educate my LPs, and you know, it's relatively effective. But to Jeremy's earlier point, the constant uncertainty has existed, but I do think right now, and this is why the opportunities are available right now, I think we have more uncertainty in almost anyone's life alive than they've ever experienced in their life. There is, you know, uncertainty on a social level. There's uncertainty on political levels. There's certainly uncertainty in the, you know, in dealing with the pandemic and economy. But this uncertainty will pass. And if you can look through the current crisis, go out, and it doesn't need to be far. I think we're going to have narratives, to your point, Jeff, we'll have narratives that show up just in the headlines. I mean, I don't think people understand on a global basis. Fauci was just doing an interview with Nate Silversite, 538.com, and he was basically explaining, that we're going to finesse this vaccine, and we're going to start producing tens of millions of doses. Several companies are going to start producing tens of millions of doses of vaccines that have not been FDA approved. There's a big headline. Okay, so now we start producing vaccine. Then at the end of the year, when the FDA approves the vaccine, we'll already have doses ready, you know, for probably, you know, certain areas of the economy first, or certain individuals first, and then, you know, 100 million into next year. So I try to educate people, Shaun, and I try to, you know, talk them off a cliff if they get too emotional. But we certainly see emotions. It's just human nature to be fearful, and there's a lot of behavioral biases in finance.
But that's a great opportunity, though, right?
That's right.
Yeah. I mean, Matthew, I think you brought up one of the best points, is that this is for sure the most uncertainty I think any of us will ever experience on just so many different levels, that like, if you can just manage your emotions enough to get through it, then it could be very, very good for your bank account. If you're actively investing and looking at new ideas right now, or compounding on ideas that you have conviction for.
At the same time, there's companies that are really benefiting from this. And so what I've chosen to do in our fund is, I mean, most of our largest holdings are benefiting from this, and they're growing faster as a result of trends that have been moved forward. And so, you know, there's two ways to look at it. You can either say, okay, I'm going to go buy the beat up kind of, you know, typical company that was growing at, you know, 4 or 5% a year. Now it's negative growth. And then bet that it returns to back to that 3, 4, 5% year growth, or you can buy companies that are just crushing it as a result of what's happened. And so as a public company investor, you get that opportunity to choose which side of the fence you want to be on.
Were there any Kodak bag holders here? I mean, I missed the boat.
I think it's a joke, man.
I mean, should we be looking at like GoPro? I mean, are they going to be getting an $800 million loan to make some vaccines? I mean, who knows, right? Hey, look, full disclosure, not a shareholder in either.
Yeah, so full disclosure, you guys know, I don't own this one. You guys are familiar with Lazy Day Holdings, the RV dealer?
Yeah.
So there was at ValueX this year. We were at one of the nights, late night at the bar and talking about ideas. And I can't remember the guy's name. A really nice guy. He was the Norwegian special ops guy.
Oh yes, yeah.
So this is like January, right? He's pitching me on Lazy Day Holdings, and it's an interesting story. And so we were actually going to look at the warrants, and we kind of briefly looked into it, and then we got on some other ideas, and we just never really acted. And go look at a stock price chart on that thing, man. I mean, and really, people are, they're never going to fly again. It's they'll buy an RV and head off across the country. And I mean, that stock has been a huge, at least the stock price has been a huge beneficiary of what's happened in the last.
Yeah. What's that online wine seller in the UK that a bunch of value guys owned? I've seen it pop up in a ton of letters. It's up like multi-bagger status. It was just a little kind of shitbag wine reseller with no seeming competitive advantage, that just right place, right time. It's sold cheap, and now people are waving the flag like, see, I told you so.
I don't know.
Yeah. Look what a 5 times earnings business can do for you.
Right.
But people are ordering wine online, and they were, they did it. Yeah. I think it would have been hard to call that, but without the pandemic, they wouldn't have. But there's definitely some typical business, old economy.
I mean, down here in MicroCap land, it's. I mean, there's so many of these that are just you would never think as a result of pandemic that are. I mean, you would after the fact. Maybe a week into the pandemic, you'd be like, wait, this makes a lot of sense. But yeah, sorry, Shaun.
No, I was just going to say, like, the uncertainty question is really interesting. Like, for sure, the uncertainty is higher. There's some additional risk premium that's necessary for that. But it's interesting to me that sometimes when you zoom out and you think longer, the uncertainty gets reduced, right? Like my precision on what any company is going to do over the next 3 months is like very low. But if you zoom out a year, 2 years or something, like in some cases, your confidence can actually go up and the uncertainty, I think, is reduced. Like what would you all say the odds are here that COVID gets resolved, or that capitalism develops some solution? Because you do have like one of the biggest prizes in the history of capitalism, on a very problem, and an unprecedented amount of intellectual and financial horsepower, literally with every scientific site in history. This is the most effort humanity has ever put forth towards something in history. So like, what are the odds that this gets resolved in some very meaningful way over the next 12 or 24 months or something like that from here? I mean, what would you all say the odds are that there's some?
They're very high.
Very high.
The probability is extremely high. I mean, do you guys remember the longitude problem when they couldn't solve? This is way back in the day. There's a great book on this, when they couldn't figure out a clock that would accurately keep time on ships, so they could correctly figure out where their longitude was. So these clocks, so they'd get at sea, and like the salt would get in them, and like ships were getting lost, all kinds of stuff. And they wanted to get a clock that could keep good time at sea so they could measure the longitude. What did they do? They held a contest, and whoever could figure this thing out had a bunch of money. And lo and behold, once the incentive was there, the world puts its minds together and solve the problem. And that's just one example. But when humanity comes together and is properly incentivized,
yes,
it's 90% plus that we get this thing resolved in a meaningful way within 24 months.
But you guys listen to the congressional hearings where they interviewed the CEOs of the companies that receive government funding that are working on it, and it was incredibly. They were all, for the exception of, I think it was Merck, or one of them was saying that it was going to be kind of mid 2021, but the rest were really bullish on a short time frame. These are companies going to congressional hearing publicly just stating, yeah, we think we've got this, and I don't think you would see that. I think it was a week and a half ago or something. I mean, you can go on YouTube and watch the hearings. I mean, there's no way that they would be that bullish, all of them. if we didn't have something in the works. And several of them, and I forgot the names of them, several of them already have one. And there's some in Europe that have it. In Germany, they're already manufacturing it, just waiting for approval, which I was shocked to see.
I mean, I'll flip the question, Shaun. What do you guys think the probability is that in 5 years we're still sitting here in the exact same situation we are now? Nobody's really going anywhere. I think that's extraordinary.
It's very close to zero.
Oh, I hope not.
Yeah.
I hope anyway.
No, incentives are so powerful, but I'll point out we don't actually need a 100% cure-all either. So if we have like a 70% efficacy with a vaccine, or maybe even more importantly, we just learn how, and we are learning, and we learn how to get the mortality rate down. Now it becomes like a very severe flu, and people can go back to a much more normal state. So I think the 12 to 18 months that was originally stated in March is probably fairly accurate. And I think that there will be positive headlines that start showing up as the FDA approves vaccines, as we start to have vaccines being developed. The incentives are so powerful. And so we're going to have multiple companies, probably multiple vaccines. And I think in 2021, what that will lead to, as people go out and either take their $5 trillion and start putting it either into the economic system, or they start investing it, it basically means that we will have earnings surprises to the upside. I don't want to be too macro here, but I think people are so bearish that the surprise is going to happen on the upside, and that will continue to drive prices.
Absolutely. And there's a middle ground here too, because I think doesn't get discussed a lot, which is just people with or without a vaccine, people are going to live and move forward regardless. And nobody's wanting to talk about that. But most people are not privileged enough to shelter in place. That is the most developed world, 1% of the world or less can even fathom that luxury. Most people, we have an investment in Brazil, a large investment in Brazil. A large part of our fund is in Brazil. And, just talking with people and listening to reports about people on the ground floor, they don't have money to sit at home and do nothing. So they just move forward.
Right.
Yeah, people die. That's just the way it is, but they're still going to move forward. They're still going to go out and buy pizza. They're still going to go out and buy this. They're still going to operate, and they're not going to zero. So there's this interesting dynamic in the market where people price in this kind of extreme outcomes, but instead it's very probabilistic that you could have something just in the middle. And even if there isn't a full availability of the vaccine to everybody, people are not sitting home doing nothing. And so as a public company investor, again, you get the opportunity to invest in companies that are able to continue growing. And there are people are not, again, they're just not going to sit at home and do nothing. People are moving forward. And we see that here as well. And I know Europe is a lot different than, an emerging market or something, but people are not just going to sit at home and just wither away and die.
I think especially in some of these countries, it's been fascinating to watch Brazil go through. I also invested in a company that's there in size. And I mean, loan volumes have been growing. Like, it's actually been really instructive to watch this. And I was talking to a friend of mine that owns a big investment in some frontier markets. And he was like, look, like you can't trivialize even one death. So that's not anything I would ever try and suggest that I'm doing. But COVID, relative to some of the challenges some of these countries face historically and in the future, like, in Africa, where you've got HIV infection rates of 20% plus, Ebola, you've got like, even just malaria, or like, some of the other things that we vaccinate for in developed countries that are just not caught on there, that are fatal. Like, COVID is just not as serious a disease as some of the other challenges that they were facing 6 months ago, a year ago, 2 years ago, that they will face in the future as well. And so some of these economies like hit a big speed bump, obviously, like the rest of the world, while everything stops, and have just come roaring back because, one, the people don't have the wealth to sit at home, and two, this just isn't as bad as the other diseases. I mean, malaria, just not as bad as some of the other diseases they're all facing. So it's going to be interesting. And I wonder if sometimes the world is making, as investors, some of the world is making this harder on themselves than they need to be. Because if you just zoom out 2 years, and you can find stuff that's going to go up 2 or 10x from here whenever this is resolved, like maybe that's the easiest trade in the world, is to just take that view and to just step back and be like, look, at some point capitalism will fix this in 24 months, and stuff is going to go up to 10x. Under any sort of middle of the road scenario, and then you get a free look on the really nuclear roaring 20s upside scenario possibility, which you don't have to underwrite in order to own this stuff. And it's really interesting to see people become so short-term focused, where they're trying to guess if the debts are up this month or down this month, versus in 12 months this is going to be fixed, because
let's be clear that it's going to be volatile. Okay, it's not like things move in a straight line. That's what you get paid to do, is sit there in the face of volatility and uncertainty with your conviction on these firms that can go up 2, 5, 10x. So I expect that many of our holdings in our portfolio will be extremely volatile. We have firms that move up and down by 20, 30, 50% in a series of weeks. But over the long term, when all this uncertainty passes, again, I think we'll be sitting in a place where we have a number of our firms will be up 3 to 5x from here. And then things look very attractive.
So if I could pose one, oh, sorry, man, I didn't mean to cut you off.
Go ahead, Robert.
No. You want to finish that thought?
It's fine.
Okay. Well, because I want to ask, I'm going to throw this question right back at you. Okay. So I want to ask everybody their thoughts, now just from your own investing strategy and philosophy perspective in the last, I guess 5 months, 4 months, what are some things that you've seen either within your own holdings, or maybe some companies that have been on your watch list that have either caused you to change your perspective on hey, I'm going to load up more or take a starter position, or I'm going to start selling off a little bit because of some of the things that they did. What are some of the things that you've seen some of your portfolio companies do? Matthew, to you.
Well, one thing that's really fascinating. So part of our strategy is that we'll use short put contracts. I call it structured value. We'll use short put contracts as a tool to enter into equity positions. And over the last 50 years, we've seen the VIX, which is the fear index, basically spike into about the 40 range 5 times. And in March, the VIX went to 85. It broke all historical records. So basically, people are so afraid right now. And what happens when the VIX rises, and that's basically a reflection of volatility, is it's basically increasing the premiums that are available for basically selling these contracts that we use to enter the position. So when the VIX rises and equity prices fall, and we're looking and doing bottom-up security analysis, it is an extraordinary time to put capital to work through these products. And so through this entire process, every single month, we've been writing these contracts, buying securities, finding opportunities, and putting money to work.
I'll let everybody jump in.
Yeah, so in a lot of our companies, I have been super impressed with how well management's been able to adapt their cost structures, and to be honest, like we're going through earnings season right now, and every one of our companies that's reported has surprised me on multiple fronts. Revenue, start at the top line, have not been hit as badly as I feared. Cost control has been very impressive. Liquidity has not been an issue. I've been really impressed about how they've been able to manage their cash flow, and it's given me, just in the companies that we own, a tremendous amount of confidence in the management team's ability to adapt. And if they can get through April, May, June with everything still going pretty well, then I think this is the worst of it, right? And so, we own a small shopping center anchored REIT that has a lot of properties throughout the South and the Southeast. And I think in June, they collected, I want to say it was 72% of the rents. I was super impressed by that. And I'm like, in the securities, we own some preferred stock, and we own actually a little bit of their common, which we're trading at such huge discounts. It's like, look, if April, or actually I'm taking it back, in April they collected 72% of the rents. If April did not kill this company, then I'm super confident. The management team adapted, they brought costs out. it's just given me a lot of confidence that the companies that we own are going to be fine and get through this. And so, yeah.
Yeah. And so well, maybe in February, when things started looking like, this could be an issue, and when it started, so we only have a handful of positions. We're super concentrated. So when I say we sold something, it's kind of a bigger deal than maybe a manager that has 30 or 40 positions. Had a large position in XPO logistics, and had for a long time. It's we love Brad Jacobs. We love what they've done. And decided to take long-term capital gains on that, realized that, and because I wasn't sure how this pandemic, if it became, or how, at the time it was just, it was isolated in China, if it grew globally, how it would affect the global logistics business. And this is one of the largest global logistics companies in the world. And late March redeployed that just basically back into the portfolio, into companies that are growing at the expense of the old guard, and just organically on their own because of a new demand for their products or their services that are kind of unleashing, the potential in the new economy. So sold XPO, and actually added to our two largest positions, which are Spotify and Roku. And in the case of Roku, which means 6 in Japanese, so maybe it's appropriate for the your sixth episode here. It wasn't necessarily about, there's just people sitting at home watching more TV. It wasn't that at all. It's just that COVID, for example, has unleashed what's happening in ad tech, and the technology, and the ability to deliver ads over streaming, and specifically in television. It's just growing so fast. And this is the market leader, which only has less than 2% at the time, had less than 2% of the total market share of ad revenue. Which almost half of ad revenue in the US was still in traditional media. So what's the chance that, the market leader in streaming television, so not mobile television, but television at home, not mobile, but television. What's the chance that they're gonna, be able to gain more than 2% of the pie? And so a company like Roku has the ability and the opportunity to reinvest 100% of their gross margin back in the business, and they have the cash flow, the free cash flow there to be able to do so, to grow their business. And so looking out over 3 to 5 year period, it just felt more interesting to reinvest the capital from XPO in our two largest holdings, Spotify and Roku, than it was just to sit and watch XPO halve in stock price and then hope for a mean reversion over the next 2 years. It just made more sense to concentrate more on our best ideas. Even though all 3 of those companies have what I would call some of the very, very best management just on the planet. All sort of somewhat founder or are founder controlled, large insider ownerships, but obviously very different businesses. So a company like XPO, logistics, hard assets, it's just going to be much, much more difficult for them to recover, and then get back to where they were and then start growing again, versus a company like Spotify and Roku that are able to accelerate their growth as a result of COVID.
Absolutely. Shaun?
I think there's like 3 categories of this that are really, really fascinating to me. I think the first thing that I think about is, Amazon traded at like $1 a share in 97 on a split adjusted basis. And it would be really fascinating to go back and try and figure out who held it throughout that whole period, where it had years that it was flat and it had more 50% drawdowns than you can count. And it went up 3,000 times. Like that first letter that Bezos wrote is amazing. And I don't think it's that hard to think that had you read that letter in 97, you would have said, this is an inspired leader who is on an amazing mission. Like recently, I've been going back and watching some of the original Jobs presentations when he came back to Apple, and that traded for a net valuation at one point. And those presentations are incredible by any measure, by any person. They are some of the best. If I saw a CEO who presented like that today, I would buy that stock at any price, basically. That's an amazing leader. And so I just think that how many people bought it and doubled their money and then sold it and felt really smart and then watched it go up another 2,900 times? Like most people probably. And so I think that that's something I think about a lot. I think that on the competitive side, it's really interesting that like something like my local burrito shop is bankrupt and will never come back. And Chipotle's digital sales are growing 100% year over year, and we'll put the physical sales soon. And you know, in a lot of ways, there are companies that are benefiting from this massively as this has played out, and that has surprised me. And when this bounces back, they will take all of that market share and then some as well. And then lastly, I think there's a lot of really interesting businesses that are seeing like really non-linear structural improvements to their businesses that have real permanence. Where they, you know, they're businesses that we own that are in technology that were growing 50% year over year before this, that are now growing 150% year over year. And they're businesses where scale and network effects matter. And so you just have like structural non-linear improvements to these businesses happening today. And I think it's really hard. I certainly struggle with it, like thinking in these non-linear second order consequence type effects where you've got these permanent structural improvements. And if you even have a small edge on somebody and you just iterate that over and over and over again, eventually all of their, you know, you just get all of their lunch. Like you just have to iterate that over and over. So if your structural advantage in a permanent way is widened versus your competitors, and then you play this game where your competitor loses and then they die, and then you take their business, and then you do that over and over and over again. Like I think a lot of people are starting to get hung up on valuation or stocks are up a lot, and maybe not understanding there's been like non-linear improvements in these businesses. You think about what's the proper valuation you can pay for a business growing 200% year over year and has some runway to continue doing that for some time. And if it's run by a visionary leader that has a really amazing business already established and has an amazing vision for where they're trying to go with just a massive opportunity to make the business into a much bigger thing, like these are very special opportunities and special times to be an investor. We should be sort of proud for the opportunity to invest right now.
Absolutely. And just one closing, just to follow up on that real quick, Shaun, that was great. And I think that's our job as investors, is to look at the future, not the past. I mean, I can't imagine one of Buffett's original investors saying, "Yeah, Mr. Buffett, we're paying you to invest in the past." You know, nobody got rich investing in the past. So many people say, "Oh, how do you know? How can you tell? How can you tell it's the next Jeff Bezos?" No, it doesn't have to be the next Jeff Bezos, but our job is to look at the future and not the past, and not be subject to what we were talking about earlier, which is extrapolating the past into the future, because that's how you get, that's when things go wrong. And in order to stand out, you need to have a view on the future and not the past. So it is our job to try to figure that out and understand that. So yeah, I appreciate that comment.
All right, so we are there. Let's get everybody's final thoughts, and then also where everybody can go and find you, both your website and if you have a social media account or Twitter account, you know, or something like that where people can go follow you. So let's go, Jeff, and then we'll go counterclockwise.
Yeah, okay, so my final thoughts is I'm probably, of the group here, probably the more traditional value, looking for cheap stuff, although we don't extrapolate the past. We need to understand our businesses to make sure they can thrive in the future. But I would argue that value investing historically, we know that it's worked very well. We also know that traditional statistical value has done very poorly over the last 10 years. But I would say, you know, you need two things to happen for the traditional value to work. You need very cheap valuations, and you need mean reverting situations. In the last 10 years, we have not had that. We've had valuations, even on the cheap stuff, have been elevated, and you've had more than your statistical share of non-mean reverting situations, in the sense that businesses, to Jeremy's point, that are just being permanently disrupted, that are dying, that, you know, the Bed Bath & Beyonds of the world. With COVID, we have seen since March, given just this is a virus that is bringing up our most instinctual survival instincts, if I said that right. And people are rightly scared of what the future will look like. And that you take that mentality and you overlay it onto pricing risk and assets, and you get a lot of inefficiencies, a lot of mispricing. And I think today, in a lot of names, we're seeing very, very cheap valuations. I mean, companies trading, their market cap is maybe 2 or 3 times their levered free cash flow, crazy valuations. So you're getting cheap valuations, and I think you're getting a lot of mean reverting situations. So companies that are good businesses that are not being permanently disrupted, that you can buy at very attractive valuations. And so I would encourage people, if you have a more value-oriented bent, to take a look at these businesses and really try to understand what the future is going to look like for them. That is crucial. But I think it's a fantastic time, whether you're a growth investor, a traditional value investor, to look through all of this and take advantage of the opportunities being presented.
Very cool. Jeremy?
Yeah, so I'd just
Wait,
like to
real
say
quick.
Jeremy,
hold on. Jeff,
Yeah.
where can people, what's your website? Where can people
Sorry. It's Thorpe Abbotts Capital, THORPE Capital.com. And a lot of information on there on our kind of behavioral approach. And we have an info at Thorpe Abbotts Capital that you can send an email to, and I'd be happy to talk to anybody that's interested to carry on the conversation.
Cool. Jeremy?
Yeah, and our website is jdpcap.com. You can sign up for our quarterly updates. I started doing a video Q&A. Last quarter, it was very well received. We're going to continue doing that. So if you signed up for the updates, that'll allow you to ask a question for about the next quarter. So jdpcap.com. And I guess final thoughts, over the last 9 years I've been doing this, there's only a very small handful of people that I consider real peers, and being a real peer and people I really trust, I really admire. And it's the guys on this show. Every year we get together
with you guys.
And when we met, we just knew. It was just, I guess.
I think we just met. So you throw the other.
Yeah, exactly. Yeah.
I don't want to, I don't want anybody to think they're,
Okay. Yeah. So these guys, I think anybody would, if they had the opportunity to invest with any of these guys, they're special guys, and I love the way they think, and we all invest slightly differently, but they're guys that I really, really admire. So everybody check out their websites and hopefully ours as well. But last thoughts. I couldn't be more excited about the future. It is a really, really special time, and like I said earlier, it is a unique time where you can it's a choose your own adventure out in the market, whether you like, companies that are statistically cheap, whether you like growth companies, whatever you like, there's something for everybody, and there's just great opportunity across the board. So really excited about being a public company investor.
That is spoken like a true father to be in a very short amount of time. So I appreciate, that's very, very good. All right, Shaun, let's go to you.
I don't have social media, and I'm not trying to be found, but if anyone wants to find me, I would love to, grab coffee once this COVID thing wears out, I guess. But yeah, I would second what Jeremy said. I've been doing this my entire professional life, and I think these are some of the best investors in the world on this group right now. And yeah, I just think that there's going to be some billionaires made out of the groups on here. And yeah, thanks for the time, Robert. It's fun to hang out with you guys. And yeah, I think some of my most formative investment conversations have been with this group over my life, and I'm appreciative for that.
That's awesome. Hey, your lips to God's ears. Let's get some hey, let's all become billionaires. Then we can go wherever we could go to wherever we want, whenever we want, right?
That's right. And if I could just, before you go, Matt, I met these guys a couple of years back through ValueX, and they were kind enough to invite me this year to go to Prague with them, and it was a blast of a trip. And they've all run funds and started funds before I started mine, and they've been so generous in their advice and helping me with questions on everything from LPs to fund structure. And I couldn't be happier to call these guys my friends, and they're amazing investors. And you will do extraordinarily well with these guys. And I couldn't be happier that they've kind of brought me into their circle. So thanks, guys.
You all have top 1% track records too, by the way. You guys have all been doing this for a long time. It's not speculation about the future. Your performance over your careers has all been exceptional.
Thank you. You too.
All right, closing thoughts here. So again, I echo. How could I not echo everything these guys are saying? Obviously, some of my closest friends and exceptional investors. We can be found at petersonfunds.com, and there's a whole lot of resources available there on the website. I think for maybe the audience here, I think one of the most valuable takeaways from this is to remember to not let your behavioral biases get in the way. So we're all sort of saying how this is a great opportunity, and it sounds really simple, but it's actually not easy. You need to dig around and find the right companies, but then you need to be able to have the conviction to stay the course. And there's going to be, the narrative right now is so bearish, and that's what presents the opportunity. But there's going to be volatility, and there's going to even be volatility in that narrative. So we will have positive headlines and negative headlines, and there will be scares and setbacks. But to be able to put capital to work today, I think will, people will be very, very successful if they're able to make that decision and have conviction in that choice.
Hey, look, as long as the four of you can lower your minimums for participation, hey, I'll spread it around. All right, let's go. But with that, guys, thank you so much for joining us today. This was so much fun. I can't wait to have you all back on at some point, and also doing individual podcast interviews as well. So again, this has been the Investors Roundtable, episode 6. There's a lot that happened on this show today. Everything from earthquakes to just awesome conversation. So I invite you all to check us out at youtube.com/SNNWire. That's where you'll be able to see every single new episode that we publish on Friday morning. And with that, thank you all. Stay safe. Good luck.
See you, Robert. Thanks.
Thanks, guys.
Thank you, Robert.